It turns out that it would have been a terrible idea to sell in May and go away. As we kick off the month of June, technology-heavy indices soar to all-time high levels again, even as inflation remains elevated, yields keep rising, oil hovers near uncomfortable levels, and geopolitical tensions refuse to fade. Memory chip makers are doing especially great this morning, unsurprisingly. But South Korea's volatility index is also surging alongside the Kospi index, suggesting that investors today are no longer buying with confidence, but with stress of being left behind. So welcome to Swissquote's Daily Market Talk. It's Monday, 1st of June. I'm İpek Özkardeşkaya and we will talk about the relentless technology rally and more. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So with the month of May officially behind us, we can say it was not a good idea to sell in May and go away. Because despite the geopolitical uncertainties around the Middle East, rising global inflation levels, rising global yields, and softening economic activity across the globe, our major global equity indices kept climbing to all-time high levels, fueled by companies involved in technology and AI. Earnings and guidance were strong enough to justify the rally, I reckon, and to some extent also ignore the Middle East war. The Middle East war, on the other hand, benefited from the pricing of temporary timeline, with US crude, for example, coming down at the speediest pace since COVID months. But oil prices eased from very, very high and uncomfortable levels still, and they stay high enough to threaten the global economic activity. US crude this morning is settling just near the $90 per barrel level, as the weekend was also marked by self-defense strikes from the US on Iranian targets, whatever that means, putting the ceasefire at jeopardy and, well, sending quite unclear messages regarding the progress on peace negotiations there. But alas, the first trading day of the new month starts on an excellent mood in Asia. The Nikkei is up by 1% at the time I'm talking, led higher by technology stocks. SoftBank rallies more than 10% today to a fresh all-time high level. Worries regarding its concentrated AI portfolio around OpenAI, debt financing massive AI infrastructure ambitions, and rising yields are all forgotten. Meanwhile, for those who still care, the Japanese 10-year yield consolidates around a full percentage point above the 1.75% mark, the level that was supposed to bring Japanese institutional money back home, remember? But well, world liquidity remains ample enough for investors to close their eyes on global yields. Obviously, other hot indices are strongly up this morning again. TAIEX, where TSMC stands for more than 40% of the total market cap, is up by around 1.60% to a fresh all-time high level right now, and Kospi rallies another 5% today, leading to a trading halt because it just rallied too much during just one session. But interestingly here, the Kospi's VIX, so the index that's showing the volatility of the Kospi index, stands near 75 today, and that's quite a high level because historically you would expect this index to hover around the 20 mark. It has actually spiked to around 40 level a few times before the beginning of the memory chip shortage-led rally, and now it stands near 75. Now this is weird because the VIX measures the level of market stress. And normally when equity prices go up, the VIX index remains at low levels because investors buy when they are not too stressed, when they have confidence, and when they build their positions slowly. And the VIX index usually spikes during the periods of heavy sell-offs because investors sell in panic and usually all at the same time. But the spike in the VIX index alongside Kospi's historic rally shows that investors today are rather buying in panic, scared to miss out on something big, but the conviction is also weakening as the prices move up and the market breadth narrows. Speaking of narrowing market breadth, indices less heavy in technology like the SOX 600 index and UK's FTSE 100 index, for example, lagged well behind the technology-heavy S&P 500 since mid-April. I'm not even talking about Kospi or TAIEX here. The rising inflation levels, rising yields, and expectation of potential and probable rate hikes from the European Central Bank and the Bank of England are actually weighing on investor sentiment in the absence of sufficient tech exposure. And in the US, last week's US GDP update landed a bit softer than expected, while the Canadian GDP data printed the second month of decline, suggesting that Canadian economy has now stepped into a technical recession. Elsewhere, China's latest PMI data came in quite mixed. The official PMI figures there hinted that the manufacturing PMI just fell to 50 level, so that's the threshold that distinguishes expansion from contraction. Yet the Caixin PMI index hinted that the slowdown in manufacturing expansion was slower than expected by analysts. So the question is, what's next? The answer is, it depends. Global oil reserves are falling fast. The markets are now pricing an extended closure of the Strait of Hormuz, meaning that the upside risks to oil prices are looming. It is said that the fact that China has been using its vast oil reserves to keep running has been one of the major reasons keeping oil prices in check throughout the conflict in the Middle East over the past 3 months. But no one knows when China will start running out of energy and will start tapping in the international markets again. But what we know today very clearly is that the situation in the rest of the world becomes tenser by the day. Exxon's senior vice president, for example, warned that we are now approaching unheard level of inventory levels, he said, and that oil prices could actually spike to $150 to $160 per barrel level in the next 2 to 3 weeks. They wouldn't stay there, obviously, as oil is not like Kospi index. When the prices go too high, the demand weakens enough to keep the upside capped. But betting for peace when the related news are unideal and unsupportive carries risks, obviously. So coming back to what's next. Well, if the dust in the Middle East settles in the next few weeks, 2 to 3 weeks ideally, global yields could ease and the latter could support capital flows from technology to non-technology pockets of the market to balance things out. But if yields keep rising, a correction, even in technology, will be inevitable. So let's see what happens. On the data front this week, investors' focus will shift to US jobs data. The US economy is expected to have added around 95,000 new non-farm jobs last month, with wages growth slightly down to 3.5% level on a yearly basis. That's still above the Fed's 2% inflation target, but Americans' squeezed purchasing power today and rising debt levels will probably help the Fed watchers look past the actual number when it comes to wages growth and focus on whether this number is softer or stronger than expected. So a set of data, NFP data and wages growth data in line with expectations will likely keep the Fed expectations balanced, meaning no rate cut this year, but no rate hike either. A set of stronger than expected figures could further boost bets for a late year rate hike from the Federal Reserve, while a set of softer than expected figures will hardly bring the rate cut hopes back to the table before the Middle East war ends. So the US dollar index remains seated above its 50-day moving average this morning as US crude rebounds 2% on meager progress in US-Iran talks during the weekend. While the FX activity in most majors remains quite uneventful, the dollar yen is slowly progressing toward the 160 level, approaching the territory where the Japanese officials become increasingly tempted to intervene either verbally or effectively to cool down the selling pressure in the Japanese yen, and the situation is giving an opportunity window for the tactical dollar yen short positions to enter quite an easy trade if they have the nerve to do so. Across the equity markets, US futures are in the positive this morning at the time I'm talking here, while the non-technology European indices hint at a slow start to the week, confirming that if you strip the technology out, the rest of the world industries look pretty bleak. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.